Hey everyone, so we are roughly 20 videos old and have completed 2 months. Money Control, CNBC and others have actually picked up our recommendations. Thank you so much for all the love that you have showered so far and the constant support. But the one person who was the motivation for this channel, my wife, she stands completely unconvinced. Here's what she said.
Ashish, I do not understand the terms you use in your videos. What is that? Who owns the share? And what are we sharing?
Wait, what? How do I simplify an already simplified topic even further? मैंने तो सजेस्ट भी किया कि एक फाइनेंस कोर्स कर लेना. उस रात को मुझे फ्रंट रूम में सोना पड़ा. So I spent hours, days thinking about what should I do. I now have a plan. A crash course on some of the key terminologies. I need a much tighter strategy, but for now, I need a way back to my bed. So let's set the plot. Also, a disclaimer, this video is only for simplifying the terms. This is for beginners. There are layers and layers of definition within each, which we can chart out in our future videos. Let's own a brand new franchisee in IPL called Incredible Indians. II for short. If there are 10 of us owning it, it means we are sharing the ownership. So, a share is a unit of ownership in a company or an asset. In our case, it is a share of our IPL team. Collection of these shares makes a stock. The person who owns the share is called a shareholder. Given we are all friends and family owning the IPL, we are a private company. Now let's make our team a national sensation. We would need to hire world-class players, do a lot of advertising and a bunch of other things. While money cannot buy happiness, we need serious money to run this team. So here are a few ways to raise the money. We can go and ask someone to give us money. If we do that, we'll have to pay it back to them with an interest. Think bank loans and interest. So in essence, we are in their debt. There are several types of debt and we'll focus on a couple. If we take money from a bank, we take a loan. It's a very simple thing that we have heard before. If we take money from individuals or investors, we will be in a bond to repay the interest. This is called a corporate bond. Now, one thing to remember is that we are forever going to be in pressure to pay back the debt and the interest. On the other hand, we could be confident about our team's success. Why not? You have me at the helm. That's how I convince my wife. So let's convince some people to pay us money and become shareholders. If you want to do that, we need to go to a place to buy or sell our shares. This is called a share market. In India, we have 2 share markets or exchanges. NSE or the National Stock Exchange and BSE, the Bombay Stock Exchange. There's an interesting story about how this all started, which I'll tell you someday. We can also reach out to some of the investors or some individuals and ask them to give us the money. In return, we will give them some of our shares. This is called a private placement. They can sell these shares on the share market whenever they want. We can reach out to the public and say, we are Incredible Indians and we will win the IPL. Those who believe in us can give us the money in exchange for some of our shares. As we are doing it for the first time, we'll call it Initial Public Offering or IPO because we give it out to the public. The next time when we do it, when we need more money, we'll call it Follow-on Public Offering or FPO. And now that we have public money coming in and flowing into us, we are a public company. The money which has been raised this way is called equity. So putting all the money that we receive from all the shareholders together is equity. Some companies raise more money from their debt than equity. Others raise more equity than debt. And this ratio is called debt to equity ratio. And what it does is it shows how much we as a company are reliant on the loans. Why? Because we need to remember we need to pay it back. That loans have to be paid back. Okay, so we have got the money. We'll call this money the capital. With all this money, we are ready to get our team jerseys, do a lot of advertising. It's mocha. So here we go. We win our first 2 matches. A 100-run victory in each one of them. The public is going crazy. More and more people want to be our shareholders and be part of our success story. So they go to the BSE and they try to see if anyone is selling the share. To attract a seller, they quote a price. This is called a bid. They continue to quote higher bids or prices to convince someone to sell the share. This trend of increasing share prices is called the bull market. But alas, our success did not last long. We lost the next 2 matches. Public has gotten angry and they started getting rid of our shares and started quoting lower prices. This is the bear market. Now bear in mind, sorry for the pun, but these names are due to their attack styles. Every match we win, the price goes up, and when we lose, the price goes down. If only I could have predicted whether we're going to win the match or not. How fast the price keeps going up and down is actually volatility. And the number of shares that get traded each day or within a period is called volume. Now, if we were to track prices of all the teams together, we'll call it an index. In India, we have two major indices. The Nifty, it's an index of 50 most valuable stocks which are traded on NSE. And Sensex, which is the index of the 30 most valuable stocks that are traded on BSE. Okay, but I digress. Let's come back to our IPL team. For each match which we win, we get some money from ticket sales, from sponsors, and of course the big check for winning the match. After I pay all my staff and all the party expenses, I have profits. My profits are called earnings. Higher my earnings, much better players and coaches can I hire the next year. Financial analysts also like to see how much earnings they have got per share. And this is done by dividing earnings by the total number of shares the company has. This is called earnings per share or EPS. This is just a nice to know number which is used for further analysis. In your mind, higher the EPS, most likely the firm is doing really good. Now, I spend 85% of these earnings to buy new players at the auction and new coaches. I even design a cool new team jersey. For the other 15%, I thought why not reward everyone who invested in my team and bought my shares. The portion of profits or the earnings paid back to the shareholder is called dividend. Remember, I'm also a shareholder with a lot of shares, so that's the only way I'm getting paid from the company. Hey, I'm going to buy my Lamborghini. Also, not all companies pay dividends. Some decide to invest the entire portion of earnings in company growth, or to pay off loans, or maybe for the annual bonuses. And there is nothing left for the shareholders. We are the nice ones. We decided to reward our shareholders. Makes us popular. Alright, that's a lot of technical terms. Now, for some slangs, street cred, let's get you on the road. Blue chips. In IPL, stocks of Chennai Super Kings or Mumbai Indians will be the blue chips. They have proven winning record, quality players, and are expected to win more than others. On the other side, Incredible India or our team will be a penny stock. It's our first IPL. We have no track record of playing IPL or owning a cricket team. Market will not be ready to pay a lot for our stocks. And specifically, if our share price is less than 10 rupees, then we will be called a penny stock. Alright, so the matches are going good, the league is going great, and we won 12 out of our 14 matches. Investors are ready to pay increasing prices for our shares. You could say our shares are growing to the moon. The opposite of the moon is tanking. And the last smart slang, YOLO. You only live once. And it stands for the idea that you go all in one stock and hope for the best. Let's not do that. Let's never do that. Which is why I'll finally tell you what I do. The fundamental analysis. In our team, the batting coach assesses each player's batting strength and their weakness, their hitting power, the batting average, sprint speed and others. And then we make an informed decision. This is fundamentally analyzing the team. Hey, wait, we should take Dhoni. Oh damn, we can't afford him. But if you were to do the same thing for the company by understanding their business, their industry, their competitors, the management, performance and others, you're fundamentally analyzing the share and trying to find out what is the fair value that you need to pay. Alright, with that, that's my time. Hope I get my wife to comment understood on the video. I'm going to pin that. I miss my bed already. Till next time, and do not forget to like and subscribe if you really liked the video. Let me know in the comments if you want more videos like this in the future. Thank you.